welcome back. So, I reiterate that the face value is the nominal value of the bond, it is the value of the bond that is given in the contract of issue, it is the value of the bond that is relevant for computing the actual cash payment on account of interest by applying the coupon rate to what? To the face value of the bond. Similarly, the redemption value is calculated by reference to the face value, 10% above face value, 10% below face value, or at face value, as the case may be. So, face value is a notional or a nominal figure which is given in the contract of issue of the bond. Now, another point that needs to be emphasized is that the face value is not the price of the bond. It may, or in fact it may or may not be the price of the bond. If a bond is quoting at par, then we say that the bond is quoting at face value, but a bond may quote at above its face value, the bond may quote at below its face value. We will examine this feature more and more as we go further, and similarly the redemption value may be the face value or above face value or below face value. There is no legal restriction on fixing the redemption value at above or below the face value of the bond. So, coupon rates and frequency I have already explained. If coupon rate is the contractual rate of interest, it is the nominal rate of interest which is given in the contract of issue. Again, it may or it may not be the market rate of interest. Please note one fact, market rate is a dynamic rate, it changes from time to time. From 1 minute to another minute, the interest rates may change, may not change, but the coupon rate is fixed once and for all for the life of the bond. Either the coupon rate itself is fixed or the manner of computation of the coupon rate is fixed. In other words, if you have a floating rate instrument, then the coupon rate may be tagged to the value of another reference rate. However, even in that case, the manner in which the coupon rate is to be computed from that reference rate is specified in the document of issue of the instruments of the bonds. So, an example here to clarify what I have been saying. $1000 par value semi-annual coupon bond with a 5% coupon rate. So, now please note this is a semi-annual coupon pay bond. So, in other words, the interest would be paid at intervals of 6 months, and what is the rate of interest? It is 5% per annum. So, for each half year, based on the convention that we follow in the money market, this coupon rate is halved. So, for each half year an interest rate of 2.5% is paid. 2.5% of what? Of the face value of 1000. So, the actual flow of money, actual payment of interest would be 2.5% of 1000, that is 25 units of money at the end of every 6 months. Now, we come to a very important concept called intrinsic value. In fact, the core objective of this security analysis segment of this course is related to the determination of intrinsic values. See, intrinsic values are not only security centric, in other words, they are determined or they are based on the nature of the security, the cash flows and the riskiness of those cash flows in relation to a security. They are also investor centric in the sense that intrinsic value calculation by an analyst would work on the basis of certain models which the analyst identifies to be appropriate and on the basis of inputs which are estimated by the analyst again. So, as far as the calculation of intrinsic value is concerned, it is not only instrument centric, not only security centric, it is also investor centric. I repeat, investor centric because the inputs that are required for the calculation of intrinsic value would be determined, would be ascertained by the investor or the analyst, if the investor has hired an analyst or analyst is doing it of his own. Whosoever is computing the intrinsic value would use his inputs on the basis of his perception, and the second is the model that he is going to use for the calculation of intrinsic value is also his choice. So, the output that he is going to get is essentially his version of the intrinsic value. Now, based on what his version or what his valuation of the particular security is, I repeat, based on the investor's valuation of the security, the investor may identify underpriced or overpriced securities in the market by comparing his valuation with the market valuation which is embedded in the price of the security. So, he compares the price with the intrinsic value and he may locate underpriced securities or overpriced securities, and then that may induce him to take investment decisions in the form of either buying an underpriced security or selling a overpriced security. So, that is the role of intrinsic value, and our role in the context of this course is to identify the most appropriate methodologies for the determination of intrinsic values. So, this is the core of this course that we are now heading to. So, what is intrinsic value? The intrinsic value of an asset is the ingrained worth of the asset as computed by a potential investor using an objective model. But which objective model? That is selected by the individual, that is not selected by the market. So, the basic thing is the computation of this value is removed from the market. It does not have a nexus with the market in the sense that the investor is doing his own work in the domain of his understanding of the worth of the security. So, I repeat, the intrinsic value of an asset is the ingrained worth of the asset as computed by a potential investor using an objective model. That objective model, the commonly used objective models are DCF analysis. What is DCF? Discounted cash flow analysis. Which cash flows? That is what we are going to discuss in due course. Or the Black-Scholes model, Black-Scholes model which we will talk about when we talk about option pricing at in the second segment of this course. So, intrinsic value is arrived at by means of an objective calculation or a complex financial model rather than using the currently trading price, market price of the asset. So, this is fundamental. The intrinsic value is not determined by reference to the market valuation or the market price. It is determined by the individual on the basis of a certain model that is selected by him and on the inputs that are estimated by him. So, this is what I have been saying right now. Intrinsic value is investor specific. Okay. So, I have explained this already by comparing his valuation, which we call intrinsic value, with the market price, an investor is able to identify investment opportunities. So, key takeaways, let us go through these key takeaways of this whatever I have talked so far. Number 1, in financial analysis, intrinsic value is the calculation of an asset's worth based on a financial model. I repeat, in financial analysis, intrinsic value is the calculation of an asset's worth based on a financial model. Number 2, by comparing the intrinsic value with the current market price, mispriced securities that may constitute potential investment opportunities are identified. Repeat, by comparing intrinsic value with the current market price, mispriced securities that may constitute potential investment opportunities are identified. Analysts often use fundamental analysis. What is fundamental analysis? We will come back to it. Investors or analysts often use fundamental analysis to account for and estimate qualitative, quantitative and perceptual factors in their models. Fundamental analysis, in fact, there are two types of analysis commonly done, although there is a third version also called quantitative analysis, fundamental analysis, technical analysis and quantitative analysis. We shall come back to this at a later point in this course. Intrinsic value using the discounted cash flow model. Now, this model seems, as you will see in a few minutes, the most logical model as far as the valuation of bonds and equities are concerned. So, let us move on to what we mean by the discounted cash flow model and what is the rationale behind using the discounted cash flow model for the valuation of securities. What does the discounted cash flow model say? The discounted cash flow model says that the intrinsic value of a security as per the discounted cash flow model is the present value of all future cash flows attributable to that security discounted at a rate which is appropriate for the riskiness of the realization of those cash flows. Let me repeat, it is worth repeating. Intrinsic value of a security as per the discounted cash flow model is the present value of all future cash flows that are attributable to that security discounted at a rate which is relevant, which is appropriate to the riskiness of the realization of those cash flows. So, mathematical we can write it as the expression that is given in the bottom right hand corner of your slide. Rationale, this is what I was talking about, a rationale of the DCF formula. Let us consider two investment portfolios. Again we will invoke arbitrage. Let me tell you at the outset, arbitrage is literally an all pervasive concept. It is ubiquitous as far as the pricing of assets are concerned. Anyway, let us come to this. Consider two investment portfolios. Portfolio A, an deposit of an amount P1 for 1 year at the rate S01. Whatever rate market rate is, S01 is that market rate. S01 is the rate that is applicable to 1 year deposits, and therefore, I deposit an amount of P1 at the market rate S01 for 1 year. The amount that I get is C1 is equal to P1 into 1 plus S01. It is quite simple, straightforward. And there is another deposit in this portfolio. What is that deposit? The deposit is of an amount P2, and that is for 2 years. So, the relevant rate is S02. Why we are using suffixes, I will come back to it. So, the relevant rate is S02, and the amount that would be payable on the maturity of this instrument of this amount P2 is equal to C2, and C2 is equal to P2 into 1 plus S02 whole squared. We are assuming annual compounding to keep things tractable and simple. Now, we consider a portfolio B. A portfolio B consists of a bond. And what is that bond? What is the property or what are the features of that bond? The bond B is going to give me a cash flow of C1 at the end of 1 year and a cash flow of C2 at the end of the second year. And the second feature of this bond is the riskiness. Let me keep it abstract. I will use the word riskiness instead of a probability or something, some measure of riskiness, because I want to keep things simple and keep things generalized. So, the riskiness of the realization of the cash flow C1 from the bond is the same as the riskiness of the recovery of my deposit when I deposit P1 amount of money at the rate S01 for 1 year in portfolio A. And similarly, the riskiness of the realization of cash flow C2 at the end of year 2 from the bond in portfolio B is the same as the riskiness of the realization of my deposit on maturity of the deposit of P2 for 2 years at the rate S02. So, as far as the riskiness of the cash flows is concerned, the portfolio A and portfolio B are identical, and as far as the cash flows are concerned, we have made them identical as well. Both give you cash flow of C1 at the end of the first year and C2 at the end of the second year. What is the current value of C1 of portfolio A? It is P1 plus P2, and let us assume that the value of portfolio B, that is the value of the bond, current value of the bond is PB. Then because the risk is the same and the returns of the cash flows or the returns are the same, it is necessarily true, and there are no intermediate cash flows except at t equal to 0, which is the initiation of the two portfolios, t equal to 1 cash flow C1 with equal riskiness, and t equal to 2 cash flow C2 again with equal riskiness. Therefore, and there is no other cash flow in either of the two portfolios. Therefore, by no arbitrage condition, the price of the two portfolios must be the same must converge. What does that mean? That means that the value of the bond Pb must be equal to P1 plus P2. In other words, the market price of the bond Pb will be equal to P1 plus P2. Substituting P1 and P2 in terms of C1 and C2, what we get is that Pb is equal to P1 plus P2 is equal to C1 upon 1 plus S01 plus C2 into upon 1 plus S02 whole squared. So, this is what the discounted cash flow tells us. The current price, at least for the moment we are talking about the price, we will come back to it. For the price of a bond is equal to the discounted value of future cash flows discounted at the market rates. What is S01, what is S02? These are the market rates of discounting. So, now this was a 2-year bond. The same philosophy, the same process can be extended to any number of years, can be extended to the life of the bond, and therefore, we arrive at the general formula which is given here right at the bottom, which is V0 is equal to summation Vi, where I is the current value of deposits for 1 year, 2 year, 3 year, 4 years, V1, V2, V3, V1 is for 1 year, V2 is for 2 years, V3 is for 3 years and so on. And then substituting V1 in terms of C1, substituting V2 in terms of C2, we arrive at this formula. V0 is equal to summation Ci upon 1 plus S0t to the power t, summation Ct, I am sorry, summation Ct, where t is the point in time at which the cash flows are realized. T may be 1 for the first year cash flow, T will be 2 for the second year cash flow and so on. So, it will be summation Ct, the cash flow at year 1 will be discounted for 1 year, the cash flow at the end of year 2 will be discounted for 2 years and so on. So, this formula holds as far as the pricing of the bonds. Logically, discounted cash flow method is a real logical approach to the pricing of bonds. Now, I have two things to say about this S0t. The first thing is very important, and that is that S0t, why I have used these suffixes, why not simply S? Why not simply keep the term summation with respect, keep S common for all the maturities instead of having S01, S02, S03. The answer is that the deposit rates or the interest rates depend on the maturity of the underlying deposit. For example, if you go to a bank and you make a deposit for 6 months, you will probably get a lower rate than if you go to the bank and make a deposit for 3 years. So, that is in other words, what I am trying to say is that the rates of interest that prevail in the market are functions of the maturities of the underlying deposits. You usually get a different rate for a different maturity. Usually not always. Short term interest rates are less compared to long term interest rates. That is usually the case, but that is not always the case. It depends on the demand and supply of money for that particular term of deposit. So, that now this particular property, this particular phenomenon of the interest rates being function of deposit of maturities is given a technical name. This is called the term structure of interest rates. We will revisit this later on in the next 1 or 2 lectures, but for the moment term structure of interest rate dictates or is the term that is coined to represent the functionality between the interest rates and the term to maturities of the deposit. And therefore, because the cash flow C1 is occurring at the end of 1 year, in other words, we are representing C1 as a deposit for 1 year, P1 amount deposited for 1 year gives me C1. So, I have to use the rate S01. The C2 is related to a deposit for 2 years, In other words, I am making a deposit of P2 for 2 years to get C2. Therefore, I have to use the rate S02, and assuming that these rates are quoted on annual basis and compounding is annual, I use S02 whole square. There is another important feature, very important feature, that is that I have mentioned just now that S01 is the market interest rate for a deposit of 1 year. S02 is the market deposit rate for a period of 2 years, and by doing no arbitrage exercise, what we get is the bonds market price. Bonds market price, in other words, is the present value of all future cash flows discounted at the appropriate risk adjusted market rates for the corresponding maturities, which relate to the cash flows that are to be obtained from holding the bond. So, that is one thing. What if instead of using the market rates, I use the interest rates that are estimated by the analyst or the investor? Then the output that I will get on the left hand side will not be the market price of the bond, it will be the intrinsic value of the bond. Therefore, again I repeat, we come back to that definition. Intrinsic value of a security is the discounted present value or the present value of all future cash flows that may be attributable to the security discounted at the appropriate risk adjusted discount rate as estimated by the analyst or the investor. So, that is very important. Now, there is another feature that I would like to allude to at this point, and that is in the case of bonds, at least the calculation of the numerator or the estimation of the numerator, that is the cash flows on holding the bond, is not a very difficult exercise. Why? Because usually the cash flows are given in terms of a coupon rate, and when that coupon rate is applied to the face value or at the redemption value, as the case may be, are contractual. They are given in the contract of issue. So, you do not have to do much work in a sense to estimate the numerator of this valuation formula. However, the valuation of the denominator may be slightly subjective in the sense that you also have to account for the riskiness of the realization of those contractual cash flows. So, to that extent, I may say that the valuation of bonds is relatively more objective and relatively simpler compared to the valuation of equity, and therefore, in fact, I have taken bond valuation prior to getting into equity valuation, because bond valuation is relatively more objective in the sense that number one, the cash flows are contractual in nature compared to the cash flows that arise on holding of equity, which are discretionary, and secondly, the assessment of interest rates or risk adjusted discount rates is also somewhat easier, because we have well defined risk classes of bonds as assessed by credit rating agencies. Okay. So, what are the steps in the valuation of bonds? Well, the steps in valuation of the bonds follow easily from the very definition of intrinsic value. Number one, first of all, you obviously have to estimate the future cash flows. As I mentioned, this is not a very difficult exercise, because the future cash flows are pretty much encapsulated, are in line with the information or the provisions of the contract of issue. Then you have to not in estimating those cash flows, of course, you have to not only estimate the magnitude of the cash flows, you also have to estimate the timing of those cash flows, and then you also have to estimate the risk profile of realizability of that cash flows. For example, if you have if you are holding treasury bonds, obviously the risk profile of the cash flows would be very positive, very strong in terms of a very low default risk, whereas if you are assessing the cash flows or valuating the bonds of a corporate which is not doing very well, you may have to use a higher discount rate because the riskiness of those cash flows may be significant. So, the next step is to assess the riskiness of those cash flows, and then the most difficult step probably is to assess is to impute a discount rate which is commensurate with, which is compatible with the risk profile of the cash flows or the contractual cash flows that form the numerator of the valuation formula. Now, this is so far the exposition has assumed annual compounding and annual rates. As I mentioned in the beginning, usually the interest rates or usually the coupon payments, interest payments on bonds in India are semi-annual, although the rates are quoted on annual basis. So, whenever we use whenever we need to value bonds with semi-annual payments, first of all we need to double the number of periods. For example, if you are valuing a 5-year bond having 5-year term to maturity, 5 years remaining to maturity, you have to split it up into 10 half-year periods. The second step is that the coupon rate must also be divided by 2, because usually the coupon rate is expressed by doubling the interest rates that you are going to pay for the half year. That is the convention that applies in the bond markets, and therefore, if it is at 6% bond that paying 6% per annum interest coupon rate, then it must be divided by 2 and you have a 3% per annum per semi year, 3% per semi year coupon payment. So, that is the second thing. And then thirdly, when you do the discounting, when you work out the discount rate, that also needs to be halved, because again for reason which is the same as the coupon rate, market interest rates are also usually expressed by doubling the half year rates. Let us take an example. This is an example of the valuation of a semi-annual coupon. You have the discounting. The C 1 by 2 is the coupon payment that you get at the end of the first 6 months, and you can see the discounting is done at S 0, 1 by 2, which is the annualized interest rate, annualized risk adjusted market rate or the valuation interest rate estimated by the investor, but that is on an annualized basis. Let me repeat, what is S 012? S 012 is the interest rate that would apply to a 6-month deposit, but expressed as an annual rate. It is the interest rate that would apply to a 6-month deposit, but annualized. Similarly, S01, with S01 we have no problem, because it is the interest rate for a 1-year deposit. Because we are getting coupon payments at the end of half year, we divide it by 2 and then square the denominator. Similarly, for what is S03? S03 by 2, it is the interest rate that would apply for a deposit of 1.5 years, but it is expressed on a per annum basis, and therefore again we divide it by 2, and because it is for 3 half years, that is 1.5 year, 1.5 year means 3 half years, therefore we cube this term in the denominator, and so this is how the formula is obtained. So, I have explained this particular point. The factor of 1 by 2 appears in the denominator because even the half yearly rates are quoted on annualized basis. The compounding type mode is assumed to coincide with the coupon payments. Okay, let us continue. Let us take up this example. Calculate the intrinsic value of a 10% semi-annual bond of the face value of INR 1000, that is exactly 1.50 years, that means 3 half years to maturity. The bond has just made a coupon payment, and the spectrum of interest rates is as follows: 6-month maturity 8% per annum, 12-month maturity 9% per annum. Please note this is per annum basis, and 18 months maturity is 10% per annum. So, how do we calculate the intrinsic value? What is the cash flow at the end of each half year? Please note the annual rate is 10%. The annual coupon payment is 10%. So, the half year coupon payment is 5%. The face value of the bond is 1000. So, the actual cash coupon that the investor will receive is 1000 into 5%, that is 50. The first coupon payment you will receive at the end of the next 6 month period. So, it will be discounted for 6 months at the rate of 8% per annum, that is at the rate of 4% for the half year. The second coupon payment he will receive at the end of 1 year, that is again of an amount equal to 50, but that will be discounted for 2 periods at a rate which is 9% per annum, that is 4.5% for 2 half years. So, that is it will be discounted for 2 half year periods at the rate of 4.5%. And similarly, the third coupon payment will again be of 50 plus the redemption of, we are assuming that the redemption is at face value of 1000. So, the total proceeds on redemption will be 1000 plus the coupon amount of 50. So, it will be 1050 and they would be discounted for 3 half year periods at the rate which is 10% per annum or 5% for each half year period. So, it will be 5% for each half year discounted for 3 half year periods. That is precisely what is shown in this slide, and we end up with a figure of 1000.8929 INR as the intrinsic value of the bond. So, market price and interest rates. Now, as I mentioned right at the beginning when I introduced this topic, if S01, S02, S03 are all market rates, then what we end up on the left hand side of the valuation formula is not the intrinsic value, we will naturally get the market valuation. What is the market valuation? The market valuation is nothing but the market price of the bond. So, if I use market interest rates for discounting, the risk adjusted market interest rates or the market keeping in account the market perception of risk, the discount rates or the interest rates that I use for discounting the cash flows, then what I end up with is the market price. However, there is an important observation here. The important observation is that in this case it is very difficult to assess or to estimate the market interest rates relating to a particular bond or the riskiness of a particular bond. So, what normally happens is the bond price is actually determined by, at the macro level at least, the bond price is determined by the forces of demand and supply, by the interaction of demand and supply. So, the objective measure does not turn out to be the interest rates. The objective measure, the demand and supply of the bonds give us the estimate of the market price, which is the output of the collective wisdom of the market, and based on that pricing by the market of the bond, we can rework or work backwards to arrive at the relevant risk adjusted interest rates or risk adjusted discount rates. So, we will continue from here in the next class. We will talk about valuation of a discount bond, level coupon bonds, and then I will introduce the concept of yield to maturity, holding period yield or annualized holding period yield, and other measures of yield. And that is the agenda for the next class. Thank you.